Canada. If you're looking to grow your wealth in 2026 and in upcoming years, then this video is for you. Today, we're breaking down the best growth ETFs in Canada, the ones with huge potential, rock-solid track records, and exposure to sectors that could explode over the next few years. Let's get into it. Whether you're investing in a TFSA, RRSP, or a regular brokerage account, these ETFs can help you grow your portfolio without needing to pick individual stocks and stay until the end. I'll reveal the ETF I personally think has the strongest upside going into 2026. So now the question is, why growth ETFs? Growth ETFs are perfect for investors who want long-term upsides. With interest rates expected to cool and tech innovation accelerating, 2025 to 2026 may be one of the strongest windows for growth investing we've seen in years. These ETFs give you diversification, lower fees, and exposure to companies shaping the future: AI, cloud computing, semiconductors, renewable energy, and more. Starting strong with TEC, TD Global Technology Leaders. ETF. If you want pure, unapologetic growth, tech is one of the best ETFs in Canada. This ETF gives you exposure to global tech giants: NVIDIA, Apple, Microsoft, Amazon, and more. It's heavily concentrated in the sectors expected to drive global growth: artificial intelligence, cloud computing, autonomous systems, and cybersecurity. For Canadian investors who want high-octane returns without cherry-picking tech stocks, tech is a powerhouse going into 2025 and 2026. Next is ZNQ, BMO's Nasdaq 100 ETF. This ETF tracks the Nasdaq 100, home of the world's most powerful growth companies. We're talking about NVIDIA, Google, Meta, Broadcom, and more. ZNQ is unhedged, meaning you also get exposure to the US dollar. If the USD strengthens against the Canadian dollar, your returns increase even more. So this can be a hidden advantage. ZNQ is perfect if you want long-term, tech-heavy growth with massive upside potential. Next is XQQ, iShares Nasdaq 100 Index ETF. If you like Nasdaq 100 exposure but you want less currency risk, then XQQ is your ETF. It also tracks the Nasdaq 100, but this version is hedged to the Canadian dollar. That means you get the growth from tech stocks, without worrying about exchange rate swings. This ETF is great for people who want smoother, more predictable performance. Now move into next. For those who want Canadian growth exposure, XCG, iShares. Canadian Growth Index ETF is one of the top choices. This ETF focuses on Canadian companies with strong growth characteristics, often tech, industrial, and financial innovators. If you want growth while supporting Canadian markets, XCG gives you that exposure without the heavy US concentration. So now, if you want growth but also a little cushion, HGRW is a smart hybrid. It holds 80% equities and 20% fixed income. So you still get long-term upside but with smoother returns and better risk management. It's a great all-in-one ETF for newer investors or for people who want growth without max volatility. And finally, WXMCI, Morningstar Canada Momentum. Index ETF, a momentum-based Canadian ETF. This ETF picks stocks based on price momentum and strong fundamentals. It's not traditional index investing, it's factor investing. If you believe the Canadian market is undervalued going into 2026, WXM could be a sneaky outperformer. So which ETF is best for you? Want maximum growth? Tech or ZNQ? Worried about currency swings? XQQ. Want Canadian growth? XCG or WXM? Want growth with some stability? HGRW. Every ETF in this video has strong potential going into 2025 and 2026, especially with AI, tech expansion, and falling interest rates expected to fuel another bull market. If I had to choose one growth ETF for the next 2 years, I'd go with ZNQ. The Nasdaq continues to lead global growth, AI is exploding, and US tech dominance isn't slowing down. Which ETF are you buying for 2025 and 2026? Drop your pick in the comments. If you like this video, hit like, subscribe, and share this with a fellow Canadian investor. Thanks for watching, and I'll see you in the next one.